Good morning, everyone, and thanks for joining us here this morning. Hopefully, you are settled in somewhere, have a nice, warm, tasty cup of coffee, and maybe a muffin or a bagel, and sit back here as we share with you some of the highlights and hopefully make them also understandable of that new tax law impact on entrepreneurs. So, my name is Adrian Simmons. For those of you who know me, I'm the Chief Creative Designer here at Element CPA. And I'm also joined today by our tax and accounting designer on our team, Rachel Andohar. And we're both here to share with you some insights, sort of unpack some of the complexity of the new tax law, be able to show you a couple of examples. So you're going to see how it works for you, as well as give you a couple recommendations for what actions you may take in 2018. So for those of you who are not familiar with Element CPA, we do business and financial design for entrepreneurs. And we focus in the service and technology space with businesses around 500,000 to 5 million in revenues, helping those business owners to focus their path, automate their finances, and optimize their tax. And that's really that third piece that we are looking at today, how to optimize your tax. This legislation that came through right at the end of last year and took effect just a few days ago is really the biggest change to the business tax and individual tax landscape for the last 20 plus years. So there's a lot of things in there, and it changes really how we want to approach a lot of those tax questions that we've been used to handling and resolving for business owners. So that those answers are going to start to change. So speaking of questions and answers, feel free throughout the course of this presentation, which is slated to be about an hour, maybe just a smidge more, to type any questions you may have into the comment box. So you should see in the toolbar that's part of the webinar software here a chat box and even a Q&A box. So as we're going along, if a question sparks your mind based on what we're talking about, go ahead and type it in there. Rachel will actually be monitoring those. If it's a question we can answer as we're presenting, we'll go ahead and do that. Or if it's a question that we might need to research and get you an answer on, we'll email that to you after the end of the webinar as well. So please don't hesitate to ask those questions. That's what we're here for today. So I think I hit all the basic intro points. So why don't we dive into the presentation itself. So really, I want to show you our overall agenda for our time here this morning. And again, trying to keep it light, keep it fun and informative. First thing I want to start with is just some general themes. Anytime a new piece of tax legislation is written, there's usually a couple interpretive keys that can help unlock what the legislators were thinking and help you to understand what's going on. So I want to start there, giving you a couple of the themes that are embedded into this new tax law change. Second, we're going to switch gears. Rachel is going to give us an overview of some of the key business tax changes that we've seen. And then I'm going to show you actually how that's going to break down in terms of tax calculations with some examples that we've set up. So we'll spell that out and sort of put it on a visually for you to be able to see how it breaks down. Thirdly, we're going to take a couple minutes to talk about individual changes as well. So obviously our focus here this morning is entrepreneurs and business owners, but there are some things that interplay because entrepreneurs and business owners also file individual returns. And there's a lot of connectivity between those two. So we are going to hit some of the highlights of changes to the individual filings, especially as they relate to business owners. And then fourthly, I'm going to provide 4 recommendations that we're thinking right now in 2018 to look at for yourself. And we'll take some Q&A there at the end, just sort of depending on our time. But ready or not, here we go. All right. So the themes, these are the sort of things as you're looking at the tax legislation that you can sort of understand a little bit where they were coming from. The first one I'm going to mention is global perspective. Although we're all thinking about the domestic perspective and how it affects small business owners, the core chunk of this really was to deal with corporations and multinational corporations. The U.S. tax policy for multinational corporations has not been very favorable to U.S. companies. And that's why the last couple of years we've seen a lot of stuff in the news, like Apple and others who have been moving operations or trying to keep profits outside the U.S. market. I see a big theme of this legislation was really to try to address some of that disparity in the international tax market And some of the other stuff was a little bit of an afterthought or also got tacked in there. So understanding that a lot of this was written from a global competitiveness tax landscape, I think helps unlock this bill. There are some business-friendly provisions in here, though, and small business-friendly provisions, which is nice to see. Although, as I'm going to point out in a minute, there's a little bit of plus and a little bit of minus, and we'll see how that shakes out. But it was nice to see that Congress was throwing a bone to the business community to try to encourage economic growth and development. So it's very positive, encouraged by a lot of what we saw there. Third main theme overall is there is simplification, but it's really for a certain segment of the individual filer market. So again, most of the small business owners are not going to see simplification on their returns, and in fact, they might see a little complication. But for individual filers who are your straightforward, hey, I have mortgage interest and I have charitable contributions, and I pay, real estate taxes, they may, a lot of them are going to find that they no longer need to do an itemized tax return, and there's not going to be a lot left for them to do after they take this new standard deduction. So the estimates right now is there's going to be 27 million more people standardizing their deduction instead of itemizing their deduction. So that's really going to be a big shift to the landscape. Fourthly, a lot of the personal tax changes, as I mentioned, are sort of in one pocket, out of the other. So we add a deduction, but then we also subtract a deduction. So for that reason, it becomes really hard for you to look at one provision and say, hey, that one benefits me, I'm going to be good when I file my taxes next year, because there's another one that sort of subtracts out. And it really is going to be an approach of, hey, we need to recalculate all the lines to figure out what's the net difference. How does it actually shake out at the end? Because it's plus, minus, plus, minus, plus, minus. Okay, what was the net difference at the bottom line number? So that's important to keep in mind as a way to interpret what's going on. And then lastly, most of the individual tax changes have an expiration date in 7 years. And that includes one of the big ones, which we're going to go over today, the 20% deduction for pass-through entities, which is going to affect most, if not all, small business owners. So this is not a permanent change as it stands now, and it has the potential to sort of dry up and go away, or in the tax world we call it sunset, in about 7 years. Personally, I think this is a little tied to election times. So 7 years from now, there'll be another presidential election. So I think this enables the two parties to sort of try to wrangle to say, hey, if we're not, for instance, Republicans, if we're not held in office, then this tax law has the ability to be unwound or not extended. So, but that's important to keep in mind. A lot of the corporate provisions are permanent, but the individual and the pass-through entity provisions expire in 7 years. So keep that in mind for purposes of just making decisions and knowing what the future holds for your business and company. So that's some overall themes to interpret the legislation through. I'm going to pass the headset over to Rachel here, and she's going to give you some highlight of the business changes, after which I'm going to come back and show you some illustrations. So let me hand the headset over to her. Rachel.
All right, great. So let's go ahead and talk about some of the major business changes that have happened because of the new tax law. So the first major one is that the corporate tax rate has been reduced from a really previously high rate of 35%. Now it is 21% tax rate, which is a huge difference. So that's a major change. The other major change is this new 20% deduction for pass-through entities. And I don't know about you, but when I was reading it, it was really confusing. So I'm really glad that Adrian, in a little bit later, is going to go through an example. So hopefully when you walk away from this webinar, you're going to really feel confident about this new 20% deduction and really understand how it really works. So really, a pass-through entity can include an S corporation or a business filing a partnership tax return, which could be an LLC filing as a partnership. This new deduction also covers Schedule C filers, which often includes independent contractors or single owner companies that have an elected SCorp or C-Corp status. So the new deduction is 20% of business income, and it really is intended to help preserve the advantage that pass-through entities have over C-Corps. So like I mentioned before, not to worry, Adrian's going to dig into the specifics in just a little bit. Another change that does actually affect business owners as well is that the individual tax brackets have decreased by about 2 to 3%, just depending on what bracket that you're in. And also another change is that there is now 100% bonus depreciation, which so you can essentially, for any equipment purchases, write off 100% over the next 5 years, which will start stepping down 20% per year until it eventually disappears or the tax law changes again. But it is different from Section 179, which I'm sure you may have heard about, but essentially it works almost exactly the same with a few technical differences. So now let's go ahead and talk about some other miscellaneous changes that have affected businesses as well. So through this new tax law, I'm sure you've heard about meals and entertainment. They kind of go together. But now entertainment is no longer deductible. So if you go to you buy sports tickets, you go to a show or something like that, it has no impact on the calculation of your taxable income. Meals still remain deductible at that same rate of 50%. Another deduction that you may have benefited from if you were, for example, a software writer or in the construction or the manufacturing business, you have likely been seeing a really nice deduction on your personal return for a certain percentage of your income, which is known as Section 199. Because of the new 20% deduction for pass-through entities, which Adrian will provide an example of in just a few minutes, this Section 199 deduction has been eliminated. Another miscellaneous change is the vehicle depreciation. So before, there was a $3,000 to $4,000 cap on depreciation, which was intended to prevent abuse, so you wouldn't go out and buy an Escalade and try and write off like $50,000 in depreciation. But $3,000 to $4,000 was really low. So now Congress has made it a $10,000 cap instead of a $3,000 to $4,000. So if you want to write down $10,000 in the margin, you can go ahead and do that. And then the last change is that in the past you were able to, for net operating losses, you were able to carry back those losses for 2 years and carry them forward for 20 years. Now, you're no longer able to carry back those losses. So if you want to write that down, but you can carry forward losses indefinitely. But the thing that Congress said is that you were able before to carry forward a loss and completely wipe out your taxable income, so you would be paying 0 tax on your tax return. Now Congress says that if you carry forward a loss, you can only wipe out 80% of your income. So it's essentially trying to prevent people from making it so you're paying no tax forever. So something interesting to note. So at this point, like I mentioned before, Adrian's going to walk through an example to really make sure you understand this new 20% pass-through deduction. So I'm going to hand over the headset.
Thank you, Rachel, for going through all those guys. So as you can see, there's some big things, there's some minor things. To be honest, the legislation is like 500 pages. There's just a lot of little stuff, but we really went through, we wanted to pick out the things we thought that might be most relevant to you. Some a little bit more technical, but the biggest one is really this one, the pass-through deduction for small business owners and for business owners. So because this is actually where there's complexity as well, which is why I want to slow it down and explain it out to be a little bit more clear. We actually already had one question, which was a good one. Does this deduction apply to sole proprietors? And the answer is yes. If you're a Schedule C or sole proprietor, as we would call it, this does apply to you as well. So let's take a moment and sort of tease it apart some. First of all, the 20% deduction, it's all, the way the actual legislation is written, it says it applies to any non-corporate entities. So in this case, it's going to be a sole proprietor, a Schedule C filer. That means you file your business on your personal return. It's going to be for S corporations. So if you've elected S Corp status, whether you're a single shareholder or whether you're multiple shareholders in the S Corp, and it's going to apply to partnerships. So if you file a Form 1065 return, and many of you may be LLCs that have elected to be treated as a S Corp, or LLC that by default is being treated as a partnership. So it's going to apply to you as well. And it basically, in its simplest form, the deduction says take 20% of your qualified business income and subtract that from your tax return, which is pretty straightforward. This is one of the few types of deductions that you don't actually have to spend money to get, which is quite amazing, and it's a pretty big number as well. 20% is not a small peanuts. So it's pretty amazing. Now, you notice it does say qualified business income, and of course this is tax law, and there's a lot of definitions behind what that means. By and large, it's straightforward, whatever that business's ordinary income is. The thing they're trying to exclude is to say it doesn't include capital gain income, it doesn't include dividends, it doesn't include interest. So if you've got investment-related income that's in your business, this is not going to apply to that. But again, most of the situations we see, this is the money you're earning just in the process of doing your business. It's going to qualify as qualified business income. So simplest form, take your business income, multiply it by 20%, and subtract that off your tax return. I'm going to take the next step here, though, because then they start to introduce some limitations. And basically, if your taxable income starts to go over a threshold, and if you're a joint filer, that threshold is $315,000. If your taxable income goes above that, then there are some caps or limits that start to come into effect. Now, I want to illustrate what taxable income means, because when we talk tax, we talk a lot of different stuff. So I'm going to bring up an actual tax return here. Let me minimize this as well. So this is a tax return that we're all used to seeing. In this case, this is the 2016 tax return. And when I say taxable income, remember, because this cap is going to apply once your taxable income gets over $315,000. The first line that we call your gross income is here. So that's not your taxable income. Oh, is that displaying as well? I'm getting a note here that may not be displaying. If not, I'll just sort of talk you through it. It may just be displaying the presentation and not the actual form itself. All right, in which case I will go back to the slide presentation. So and I'll just sort of explain it. So taxable income is the ability for taxable income. Remember, we start with gross income, we subtract out, we get to adjusted gross income. Then after we subtract different deductions, that's when we get to taxable income. So taxable income is after your itemized deductions, your personal deductions. That's the number you need to be looking at. If that number is over 315, then these caps start to come into place. So for instance, we have a 50% of wages cap. So if you have taxable income over 315 and you have no wages that you've paid in the business, 50% of zero is zero, and you're not going to get to claim this 20% deduction at all. So that's an important note. Again, if you're over 315, that's when this limit starts to apply. Secondly, and this is another limit as an alternative, is it can be 25% of wages or 2.5% of property. So again, I'm over 315, which means the limits are starting to apply. I looked at the first limit. The limit is 50% of wages. If I don't have a lot of wages, this might be a problem for me. However, if I have some property that I'm making money off of, that may come to my rescue and enable me to take this 20% deduction, or at least have a smaller limit. This second limitation actually got introduced at the last minute, and this was really targeted towards those who are making money in the real estate side of the market. So if you are in the trade or business of real estate, so let's say you've got rental properties or office properties or apartment buildings, and that's your business, you may not have whole bunches of wages. In fact, you may be paying a property management company to take care of that property, but you can take 2.5% of that property's value effectively and use that as an alternative cap instead of just 50% of wages. So again, that provision got introduced the last minute. It was meant to sort of target the real estate market, so that works really good for you if you're a real estate professional or real estate business. The interesting thing about how that calculation works is it may also apply to Schedule E rental properties. So if you just have a Schedule E rental property, there's a question of, does this ability to claim the deduction apply to you? It's one of the things that there is going to still be unpacking of what this legislation means over the course of the year, of what does or does not count. My personal opinion right now is, unless you're a real estate professional, you're most likely not going to be able to simply take a Schedule E rental property, like an individual rental property, and try to claim this deduction against the income on that property. However, if you are a real estate professional, if you are in the business of sort of doing real estate things, then most likely this provision, you can use it even on your individual rental properties that you may have. So, all right, so 20% of qualified business income, which is normal business income. However, if your income, your total tax return, taxable income gets above 315, these caps start coming into play. The cap is either going to be wages or a combination of wages and property. Last bullet to know on this page, and this is a big one too, is if specified service businesses who start to have income above 315K, it's going to go away completely. And I'm not quite sure what Congress was thinking, or as I've been saying to others, I don't know why they hate, right? What's the deal that they sort of isolated out the service type businesses and said, I'm sorry, this is just going to disappear altogether for you when you get over 315K. And I just want to clarify a little nuance there. There's actually a phase out range between 315 and 415. So it doesn't just disappear exactly at 315, it just starts to ratchet down. And if you're north of 415, it's gone altogether. So again, that's a sad truth of how this law is written, and there might be some fallout to see. So let me go a little deeper into what is a specified service business, because that's pretty critical. And that's on my next slide here. So a service business is defined in the code as any trade or business involving the performance of services in the field of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or where reputation is really what's being sold by the business itself. So this is a pretty broad stroke here that the Congress has sort of defined who is going to lose this deduction when their income gets to be too much. And it's going to be interesting to see again how this plays out. In defining this law, Congress referred to a code section 1202, that sort of has this definition already there. The only problem is code section 1202 hasn't been one that's been litigated much. So there's really not whole lots of guidance around who does and does not count as a service business. So for instance, you could say like insurance. Is brokering insurance, is writing insurance products, is sort of creating the vehicles or distribution, like insurance, some of it is service and some of it is not service, and where's the line? That's very much a question that's being debated right now, and that the IRS is going to need to issue guidance on. I'm not going to be surprised within the first or second quarter we're going to get some guidance, but to be honest, I think a lot of things are still going to have to be hammered out. Myself, being in an accounting firm, we're pretty squarely in this service business, unfortunately. If you're an attorney, you're pretty squarely in this. There's not going to be a whole lot of way to get around that. If you're a consultant, you're pretty squarely in this. There's not going to be a way to get around that. Again, we tend to target service and technology companies. Most of our service people are going to be impacted by this limitation. If you're like a computer programmer, probably not going to fall into the definition of service business, just based on some of the legislative history. So, but where exactly is that line? Some of it remains to be seen. 2 services actually did get isolated out and said that they're okay. They're not impacted by this limitation, and that's architects and engineers. Part of the thinking here is that these services are connected to the construction of tangible things like buildings, rooms, other types of, let's say, bridges, other types of industrial construction, things like that. So really the distinction philosophically they're making is people who are just sort of selling their knowledge versus people who are connected to making something that is a tangible good. Just to let you know a little bit of thinking behind that is that if somebody is paid money and it's just for their knowledge, the thinking of Congress is, hey, that should be compensation and 100% taxable and not qualify for this deduction. If, for instance, you're walking into a retail store and you're paying money, that is something that part of that money is going towards the maintenance of the physical assets, so the space, the physical clothing, and things like that, and return on capital. To be honest, I feel like it's a flaw in sort of economic understanding, but I don't get to write the law, unfortunately. So that's where it stands for now. And maybe that's something that will change in the future, although there's really no indication of that, so I wouldn't hold your breath. Last thing, as I mentioned, is that these are fuzzy areas that some of the fuzzy areas are yet to be defined. So stay tuned on that if you find that you might be in one of those border areas and you're not sure which side that you are going to fall on at the end of the day. So it's really important about how the 20% deduction works. I'm actually going to go to some calculations, but I'm going to make sure that I can actually share what basically I have a Google doc that I'd like to be able to share with you, and be sure that I can toggle over to it and that you can see it. So give me just a minute. Pause. You share. Okay. And I'm going to try to. All right. And I'm just going to ask the folks here to confirm you can see, yes, the Google Doc. Great. So click the right button there. So next, what I want to do is really just walk you through an illustration. We did a lot of sort of talking about what this is actually going to look like at the end of the day for you. So I've got a couple tabs here, and we're going to look at the before and the after for 4 different scenarios, just to illustrate how this is going to play out in real life on actual tax returns. So my first example on this tab is a 100% owned C corporation. And on the screen, I've sort of got a couple things broken down. So just to sort of show you what I've got here, on the right-hand side are some of my inputs. So assumption, let's say this business makes $2 million in revenue. It's got non-wage or overhead and other types of operating expenses of $750,000. Let's say it has wages that it's paying to its team of $500,000. The owner is taking $200 in wages. The owner's drawing out profit, in the case of a corporation, that's a dividend of $150. So some of the assumptions are over here. On the other part of the screen, this is how their business return would look like, how the individual return would look like, and a combined analysis of the tax. So let's sort of walk through this together. For this 100% owned C corporation, their business return, so the corporate tax return, is going to show revenue of $2 million, non-compensation expenses of $750, wages. And remember, in a C corporation, the owner does get paid a wage as well, so that gets added in. So we're to a taxable business income on that return of $550,000. And notice before and after, it's not changing the calculation of business income at all. Where we really see the difference is the calculation of business income tax. So I'm going to skip down to this line here on business income tax. Before, we used the corporate rate of 35%. That meant the tax on the 550 was 192. After, we used the new rate to 21%, which means the tax on the 550 is 115. You notice that's a pretty big difference right there. So it's like $80,000 or $70,000. So somebody who's in that range is really going to see a big difference to the business tax that's paid. But you also have to factor in the individual side of the picture. So let's take a look at the individual return. So this business owner, who's a 100% business owner, there's their $200,000 W-2 wage that they paid themselves. So that's the same before and after. Because they're a C Corp, there's no flow-through income that's going to show up on their personal return, so that's 0. And for that reason, they're also not going to have that new 20% deduction. Again, that 20% deduction is for all non-C corporation businesses. So that's 0 on both cases. However, when you are a C Corp, and this is the main difference of what a C Corp does, is whenever you withdraw profits out of the business, and in this case we said there was going to be $150,000, it shows up on your personal return as dividend income, and it's going to be taxed at your personal tax bracket rate. So when we look at the individual returns under a C Corp, we're going to see that the taxable income is $350,000 in both cases as well. This is what double taxation is all about. And you may have heard that term. This is what it means. It means that the business pays tax on the income, and this income didn't subtract out the dividend at all. And then the dividend gets taxed. So in essence, the income has been taxed twice. Once as part of the business's income, and one when you withdraw it out of the business. So the point I want to make here is, although the corporate tax rate has dropped to 21%, when you combine it with the effect of double taxation, it's now, without the 20% deduction, it would be about the same. The pass-through in the corporations would be about the same if Congress hadn't introduced the 20% deduction. Because Congress introduced the 20% deduction, it helps put pass-through entities at a 10% overall advantage compared to C Corp. So one of my recommendations, and you'll see this at the end, is some people may be thinking, hey, should I rush out and form a C corporation to take advantage of that new 21%? The answer is probably not. There's a couple situations in which it may make sense, but even if you don't qualify for the 20% deduction, you're still going to be paying about the same overall as you would as a C Corp, so there's really not a whole lot of benefit to going through that effort. The only chance that there may be, only time it may make sense is if there's some fringe benefits, and we'll get to that a little bit later. But I wanted to use this to illustrate, this is how the corporate return changes, and that's a big drop for sure. You notice that the total tax overall dropped from $387 to $310, so that's about a $77,000 change. Certainly meaningful, but that's double taxation still exists for C corps, and it's not that part didn't go away. All right, so that's our first example. Let's take a look at a second example, and this is one a lot of you are probably in. Let's pretend that you are a Schedule C sole proprietor. So you could be a consultant, you could be owning a service business, an insurance business, a technology business, digital marketing business, etc. So let's say you're a Schedule C sole proprietor. Could be an LLC that is being treated in the default status. And let's say your individual taxable income is less than $315,000. Remember, taxable income is after subtracting all your personal deductions. How is this going to impact you? Well, first, let's take a look at the business side. You have all your normal revenue expense numbers. None of that changes. So the schedules in your tax return really isn't going to change at all. It's at $300,000. Where you experience the change, though, is on your individual return. So as a Schedule C sole proprietor, you don't have any wages. That's part of the one of the unique characteristics of this filing status. However, you do have the flow-through income of the business. So that business income we just calculated up here shows up on the first page of your individual return. So you're used to seeing that. Here's where the new deduction shows up. And it's 20%. It's basically a take $300,000, multiply by 20%, and just subtract $60,000 off the tax return. A beautiful thing. Just disappears. Didn't have to spend a dollar for it. So now you notice that the taxable income went from $300,000 to $240,000. So that's a big shift. As a result, when we actually get down to the individual tax line, you see that that goes from $84,000 to $67,000. So almost a $20,000 change for that filer. So if you're in this situation as a Schedule C sole proprietor or other pass-through entity, and your individual taxable income is under $315,000, you're very well going to see somewhere around a $15,000 to $20,000 difference to your bottom line number, which is great to be able to say is true. So there's the before and after for that scenario, Schedule C scenario. Notice no dividends, because this is not a corporation we don't have to worry about. Notice also no wages, because a Schedule C doesn't pay wages. That's going to change in our next example. Let's pop over to that. So now let's say you are an S corporation shareholder, but here's the kicker. You have more than $415,000 in taxable income when you look at your tax return. So that 415,000 means that you started to trigger those limitations to come into play. They don't come into play under 315. They come into play above 315, and they're completely in play by 415. So let's take a look at this. In the S-Corp world, remember an S-Corp is going to file a separate tax return altogether. So we've got our business return. This is the 1120S return. We've got our revenue, our expenses, our compensation. In the S-Corp world, remember a S-Corp shareholder is required to pay themselves a reasonable wage. I've come up with a number here, 125. Taxable business income, in this case, is 1.3 and change. So in this scenario, the S-Corp return doesn't change at all. That 20% deduction doesn't show up on the S-Corp return. It shows up on the individual's own return. And that's in this next section. So on that individual's own return, obviously they're going to have their W-2 they got from their business that they paid themselves, 125. Here's where the S-Corp income is also going to show up. So in this case, they were 100% owner, so all of that income is going to show up on their return. In this case, 1.3. Now we get to the new 20% deduction. So normally we would take the income, 1.3 million, and multiply it by 20%, and we would get $265,000. However, we're not able to claim that full 265 because our income is over 415. We have to apply the limitations, which in this case relates to whatever your team wages were. And in this case, you include both wages together, 425 together. Half of that is 215. So here the cap came into place. We're still able to get a deduction. It still helps us out. It's just being limited by what our wages were. So this person gets 212, 500 subtracted off, and now their taxable individual income is 1.2. So still a big difference between the two. We see the individual tax line drop from 362 to 309. So again, we've got like a $55,000 benefit here. So still benefits you if you're above 415. You just got to realize that the wages may come into play and limit you. So that's S corporation. Just a real quick nuance to this as well. Some S corporations, you may not be the sole shareholder. You may be, let's say, a 50-50 S corp, or whatever it might be, a third, a third, a third. What's going to happen is you take whatever this taxable income is, and you're going to take your percentage. So if you're a 50-50 shareholder, 50% of the income flows through to your return. You will also be attributed with 50% of the wages for purposes of calculating the limitation. So that's an important piece as well, and sort of knowing how this works. You share it based on your S-Corp ownership percentage rate. Is you're going to share in the income, and you're also going to share in the wages for purposes of doing these calculations for limitations. So that's an important nuance. All right, so that's that example. Somebody's got greater than 415, and the limits kick in for them. Last example I want to show you is a partnership. And let's say this is a 50-50 partner in a service business, all right? So this is somebody who's a LLC filing a 1065, filing a partnership tax return. And in this case, the individual income is greater than 415,000. So let's take a look at that partnership tax return. Got revenue of 2 million, sort of overhead costs 600,000, wages paid to employees 400,000. In the partnership world, you get guaranteed payments. So if you are in a partnership, you recognize that language. It's called guaranteed payments. In this case, 185 in our example. So the taxable business income, 815. Again, notice before and after, these are both the same. The business return is not the one that changes. It's the individual return. Let's take a look at that one. So this individual partner who's a 50-50 partner, they're going to report 185,000 as their guaranteed payments. They're also going to report their 50% of income as their flow-through income. So take the 815 divided by 2. Now we're going to get to the new 20% deduction, and it's not there. Normally it would have been 20%. So 407 times 20% normally would have been a nice subtraction of 81,500. The reason it's entirely gone in this example is that they are a service business. They're a specified service business. And when you're a specified service business and your taxable income is over 415,000, then it's sorry, you don't get this deduction at all. And again, this is just a really sort of sad way that this law is written, but it is the way it's written. And so there are going to be a number of folks who are going to find themselves in this scenario of just not being able to claim that 20% deduction at all. I mean, in some ways, I guess you were no worse off than you were before, but it certainly does leave a bad taste in the mouth to know that other businesses are getting it and yours is not. So bottom line, we see here the total tax between the two unchanged before and after based on that deduction. So those are our 4 examples. I just wanted to sort of lay that out for you, the before and after, so you can see how it plays out in real life. And maybe you can also insert yourself into one of these situations to say how this might actually end up impacting you at the end of the day. So I'm going to toggle back to the presentation and just to pick up some of our remaining thoughts together. So that's the 20% deduction, how it works, really the biggest impact of this, some of the complications that come with it, but hopefully we've been able to unpack a little bit of those for you so they make some more sense. That really is our goal here this morning. And at this point, I'm going to hand it back over to Rachel to run through some of the individual changes that we think are most relevant for business owners. So.
All right, great. Let's go ahead and walk through some of those individual changes that you may have started to hear about. So the first big one that you may have heard about is that the standard deduction has effectively doubled. So if you're a joint filer in the past, your standard deduction would have been about $12,000. So starting in 2018, now that standard deduction is about $24,000. So this provision, combined with the effect of the next 2 that we'll talk about, it's going to drop the amount of people that will itemize deductions by 27 million people. So it's going to have a big effect, and those people are going to start taking the standard deduction instead. Another provision that has changed because of the new tax law is the state and local tax deduction has been limited to $10,000, and that's including real estate taxes as well. So you may have started hearing about that. So if you pay a lot of state and local taxes and you pay a lot of real estate taxes, it's going to top out at $10,000, which is actually pretty low, especially if you live in a high tax state. Another change for individuals is that the miscellaneous itemized deductions, those have been eliminated. So some of those in the miscellaneous category, that included investment advisory fees, tax prep fees, unreimbursed employee expenses, legal fees for tax-related cases. Those have just been completely cut out. So you'll no longer get that benefit on your individual tax return. And then the last big change that has gone into effect with this new tax law is that in the past you were able to take a $4,000 deduction per person on the individual tax return. That was known as the personal exemption. So now that has been cut completely. So instead of the personal exemption, Congress did double the child tax credit. So that used to be $1,000 and now it's $2,000. And the other big change is that for the child tax credit, in the past, most people were phased out of the credit because of the income caps. Now the income phase out for the child tax credit got pushed a lot higher. So now you don't start getting phased out in terms of income for the child tax credit unless you were above $400,000 for a joint filer and $200,000 for a single filer. So many more people will benefit from this child tax credit of $2,000. So that actually should help. So at this point, those are the major individual changes. At this point, Adrian, let's go ahead and we'll talk about some of the other miscellaneous changes, and then Adrian will walk through some key recommendations. So one other change is that the mortgage interest deduction is now limited to $750,000. The alimony payment subtractions and additions that you saw on the individual returns, those subtractions and additions have been completely eliminated for any agreement made after December 31st, 2018. The AMT threshold has actually been moved up, so it's going to impact slightly fewer people. So that's a positive change. And you may have also heard that the individual health insurance mandate. So now, if you don't have health insurance, you're no longer going to be penalized on your individual tax return that you saw in previous years. And now, 529 plans, so in the past you used to only be able to use those plans for college, but now you can actually use the 529 plans for elementary and high school as well. So that actually is a big benefit if you're sending your children to private school and you want to be able to save for their education. All right, so those are some of the individual changes, some other small changes that you may have seen. And now Adrian's going to talk about some key recommendations that you can think about as you walk away from the webinar today.
Thanks, Rachel. Appreciate it. And hopefully it was helpful to take a look at some of those individual, especially as small business owners, there is that interplay between the business return and the individual return. So as that, for instance, as that business income flows through, because it's a pass-through entity, it's going to be taxed at those new individual tax brackets rates. So actually moving the individual tax bracket rates down 2 to 3% is a way of reducing the tax on your business income as well. So a lot of interplay between those different pieces. So as I mentioned, the law itself is 500 some odd pages long. You know, it's a little bit of a tome. So our goal today really was to pull out the things we thought were going to impact the most people, and also to try to tease out some of the implications for you as business owners. So I wanted to synthesize a little bit of what we talked about into some action items that I think you, as an entrepreneur, as a business owner, should be looking to take in the 2018 year. So let's take a look at those together now. The first one is take a look at your tax return and see if your taxable income is over 315K. And you can just look at a copy of your prior year return. If you are under 315K, you can sort of, wipe your brow and say, hey, I'm good. I'm going to get the full benefit of that 20% deduction. I'm not going to have to worry about if, ands, or buts. And again, this applies if you're a specified service business too. If you're under 315, it doesn't matter. You get the 20% deduction. It's only when you start to get over 315 and through that phase out period of 315 to 415 that those limitations apply. So connected note on that is confirm whether you're a specified service business. So for some of you, it's going to be pretty clear, and for some of you, it's going to be less clear. So seeing if you're defined clearly and keeping posted on when the IRS issues guidance or Congress issues guidance on what industries are or are not included is certainly going to be an important thing to do going into 2018. Second, adjusting your 2018 estimated tax payments. So if you are eligible for this, then obviously your taxes are going to go down for 2018. most likely, unless some other things are going on. So you may not need to be sending out as much, and it may be a meaningful number. I hope it's a meaningful number for many of you. So that means that your estimated tax payments should be something lower than they were before. So adjusting those expectations, figuring out what that new calculation is. I'm also saying this in reference to some of the individual provisions. So for instance, if you have unreimbursed employee expenses that you've claimed in the past and you're not going to be able to do that now, that's going to go away. So also based on the number of kids you have and the personal exemptions you can claim versus child tax credits. So these estimated payments is not just because of the business changes, but because of the individual changes too. Get a real read on what that is. Do not wait until next year to figure out how this tax law applies to you. Third thing I'm going to recommend considering is potentially capitalizing your business over the next few years. You may remember, as Rachel said a little bit earlier, the next 5 years, Congress is allowing 100% business expensing. You do not have to depreciate basically anything. So if you're in the business of maybe gearing up or kitting up with different things, this might be the time to do that so that you get 100% write-off now. You don't have to wait for that tax deduction for later. So this might be an opportunity to take advantage of that window of time that's open. And last thing I'm going to put on here is consider converting to a C corporation if you can't take advantage of the 20% deduction and you want to expand your fringe benefit offerings. So just because you are not eligible to get the 20% deduction is not a reason to convert to a C corp, because at the end of the day, once all the dust settles, you're going to be about the same situation as you were. All right. So the only reason it really makes sense to rush out and convert to a C corp is if you've been thinking about expanding your fringe benefit offerings, because fringe benefits are much more deductible under a C corp scenario than they are under pass-through scenarios. So that's really the only driving force there. One other thing I'll mention, and this is a strategy that one of our listeners mentioned and it's been floating around, is there may also be opportunity to consider bifurcating your business to separate, if you're affected again by the specified service, to say, oh, let me take the service part, put it here, and let me take the non-service part and put it over here. That may make sense, although given the temporary nature of this regulation, you may not want to start dividing up your businesses in that way. So in a case-by-case scenario, that type of strategy may make sense as well, but it's not as simple as just saying that's always going to be the best result for you. So, so those are sort of the four main things. See where your taxable income is, whether you're a specified service business, update your 2018 calculations, consider if it makes sense to buy things for your business, and only really look at the C Corp if you want to expand your fringe benefit offerings. So those are some of our key recommendations coming into the 2018 year. I know we've been taking a couple questions as we've gone along, so I'm going to see if there may be a couple questions going to pop out of the presentation here for a minute, and see if I may have a couple additional questions to be able to answer. So if you have some questions, please do type them into the chat or to the Q&A part. And I'm just going to open this up. So there was a question of, hey, the tax preparation fees, that was one of the miscellaneous itemized deductions. If miscellaneous itemized deductions are going away, does that mean you can no longer deduct tax preparation fees? The answer to that question is yes, but if you're a business and you have had tax preparation fees, at least a portion, and a lot of times a big portion, is a business expense to you as well. So you'll be able to claim tax preparation or other fees like from us on your business return, but anything that's attributable to the personal side is no longer deductible. Sort of a sad part of that, there used to be legal fees, let's say related to tax, that you could deduct over there. It's just that one disappeared altogether. I'm looking at some other questions here. There was one question that says, hey, if you have multiple businesses that are flowing into a personal return, so let's say somebody owns multiple different businesses, some of them are service and some of them are non-service. Does the fact that some of them are the specified services prevent you from claiming the 20% deduction, the ones that are non-service? And the answer is no. It's really done as it's defined and as it's being interpreted right now. It's really done at a business by business basis on the individual return. So if somebody owns 100 different businesses, they're literally going to have to do 20%, 100 different 20% calculations to see how much they may or may not get on each business. But they have 100 different businesses. I'm going to guess their taxable income might be over 415. So those limitations are going to kick in as well. So that's going to be a lot of fun to do that. I also had another question come in. How about examples for folks in the real estate industry with business above 415? What may go towards increasing the total deduction? Yeah, real estate, the basis in the property is really what's Congress is looking to save this deduction for people in the real estate industry. So for instance, if you have an apartment building, and let's say it's a $1 million apartment building that you're renting and experiencing rental income on, you'll be able to take 2.5% times that $1 million, and that's a way of removing or lessening the cap on you. That's really what's intended to help folks in the real estate industry. I have a feeling the brokerage services is going to apply to real estate brokerage services as well. So that becomes a critical thing to turn to some of your income from a property management standpoint, and use the basis of the property to claim at least some of the deduction. Good question. Are there other questions out there, folks? Go ahead and type them in, and then if not, I'll move to our last closing part of what we've got for you today. So as people may be typing in a couple last questions that we'll field, we want to give you sort of a couple steps you can take right now if you want to. Number one, we are recording this webinar, and so if you know of somebody who you think would like to see this and would benefit from seeing this and getting a copy of these slides, please type their just sort of information into the chat box, and we'll make sure to forward a copy of this to them. Or if you don't have their information on you right now, you can certainly email us and we will forward this to them so they can benefit from having seen this explanation and get these slides. So number one, if you'd like to forward somebody, let us know. Just type it in the chat box. Number two, if you would like to be made aware of future webinars or events that we'll be holding in person or online events, just sort of type that in there and say, hey, yep, go ahead, let me know when you all are doing something like this again. Our focus here is on tax. We also work on automating finances and helping strategy for businesses. So would love to keep you abreast if that's something you're interested in. Thirdly, if you're not yet a member of the Element Circle and you may want to consider becoming a member, just let us know in the chat box. Say, hey, yeah, I enjoyed what I saw here today. I'd like to talk to you all more to see if we might be a good fit to work together. And we'll follow up with you to set up what we call a coffee conversation. Just an opportunity. I'm back. Sorry about that. And the last step is if you are an existing member of the Element Circle and you wanted to be able to talk further about what we talked today, just let us know, hey, I have some follow-up questions, whether we want to do a meeting or just some quick questions. That's what we're here for you to do, to help you sort of unpack this and see how it's going to impact you. So again, just use the chat box, have us forward this to somebody you know. Say you want to be part of a future events list. If you're not currently a member of the Element Circle and you want to have a coffee conversation, or fourth, if you are and you want to chat more, just let us know. Thank you all for joining us. If you had some questions you submitted that we haven't gotten to today, we are going to follow up with you with email afterwards, so just look for that. We really hope that you've enjoyed being here today, and I hope you got something out of this. Our real goal was to try to take some of the complexity and make it where it makes some sense, which is hard to do when you're doing tax law, but hopefully we've done that a little bit already. So again, thanks for joining us today, and as we like to say here at Element CPA, keep building financial strength for what truly matters. Bye-bye now.